Silver investors, we are at the point in the game where one number on your screen, $92, is doing more work than any Federal Reserve speech or Wall Street research note. If silver fails here, March is managed. If silver breaks here, March changes. I'm not here to sell you signals, groups, or a secret course. This is financial warfare education, COMEX data, Shanghai premiums, March delivery math, and what a simple line at $92 really means when your exchange is almost out of registered metal. In this video, we're going to walk through why $92 is the wall in this market right now, what the latest COMEX numbers say, how much silver is left, how much is already spoken for, and how much has been pulled in just 60 days. How Shanghai at 101 plus is silently voting against Western paper pricing, and exactly what changes for March if silver closes above this wall tonight. Let's start with the one thing everybody sees and almost nobody understands, the chart. Segment 1. Why $92 is the wall. Pull up an intraday silver chart for this week. You'll see the same behavior replayed. Each run into the low 90s gets aggressive selling. The zone around $92 has acted as a cap. Spikes into it are short-lived, wicks are long, bodies are small. The most recent CME halt and $6 slam started right as silver was grinding toward that same area. That's not a random number. It's a composite level, technically, former support turned resistance plus key moving averages on the 4-hour and daily. Psychologically, the market just saw $90 flash by, watched $121 then a crash into the 70s, and is now testing the mid-zone again. This is where both sides dig in. Look at today's context. Spot silver has rocketed past $90, trading up nearly 2% into first notice day for March, according to FX Leaders and Money Control's live updates. Trading Economics and other feeds have silver closing around $90, $91 on first notice day, with intraday pushes toward that $92 band. So when I say $90 is the wall, I'm not talking about some mystical Fibonacci number. I'm talking about the exact zone, where last week's breakout attempt died, where the halt and slam began, and where shorts need price to fail tonight if they want to calm March. Segment 2, first notice day, the date that makes $92 dangerous. Now overlay the calendar. Today is February 27th, 2026, first notice day for the March COMEX silver contract. Here's what that means in plain English. If you are long March silver, and you do not close or roll before today, you gain the right to take delivery of physical silver. Shorts, on the other side, must be able to deliver or source metal for anyone who stands, according to a detailed breakdown from Jin's Substack on March delivery. Silver closed around $90.10 Oz on first notice day, up about 2.07%, as traders sought safe haven exposure. After the massive open interest collapse and the CME drama, there are still 10,526 March contracts standing. That is 52.63 million ounces of silver already demanded for delivery. Now compare that to the registered stock. COMEX has about 86.13 million ounces of registered silver ready for delivery. In January and February alone, COMEX already delivered 74.38 million ounces of silver. 49.2 million in January and 25 million, 18 million in February. Those 74.38 million delivered in 60 days equal roughly 86.4% of today's registered inventory. So going into March, registered got 86.13 million OZ, already delivered in the last 60 days, 74.38 million Oz, almost the entire current registered pile. March standing for delivery today, 52.63 million Oz, over 60% of the registered stack. That's the context for the $92 wall. Shorts are staring at a thin registered base. They just fought to crush March open interest down from over 100 Bs or Oz equivalent to 52 theaters. The last thing they want is price breaking above a big technical level on first notice day, while over half the registered stack is spoken for. Segment 3, COMEX tightness, the numbers no one on TV reads. Now, let's widen the lens on COMEX tightness. A recent metal forecast from metal.com and analysis on Seeking Alpha make the bigger picture clear. COMEX silver stocks have dropped roughly 31% over the recent period, fueling concern about a growing physical supply crunch. Registered silver stocks have fallen below 90 Menors Oz, marking a multi-year low and raising fears of a potential March delivery failure. Total deliveries in January and February, that's 74.38 Menors Oz, represent close to an entire registered inventory worth of metal moved in just 2 months. Delivery trend, January 2026, 49.2 Menors Oz, 10x the January 2024 level. February 2026, 25.18 Oz, the largest February silver delivery volume in modern COMEX history. Combined, 74.38 Oz delivered in 60 days. 86.4% of today's registered stock. Those are not normal warehouse numbers. That's a warehouse being used as a fire hose. So when you hear silver at $92 hitting the wall, understand this isn't just about a line on a chart. It's about a futures exchange whose deliverable pile is already heavily drawn down. Breaking above that line tonight, at the moment when longs can lock in delivery, is exactly what shorts do not want. Segment 4, the other side of the world, Shanghai at $101.48. While COMEX is sweating $90, Shanghai has moved on to another universe. According to recent SGER metal charts data summarized publicly, Shanghai spot silver reached $101.48 per ounce on February 27, 2026. That's about a 13.16% premium over global prices, i.e., over the Western reference. The premium is being driven by acute physical shortages inside China, along with strong investment bar demand and industrial needs like solar manufacturing. Silver Institute data adds that global supply deficits of around 200 malus Oz per year are expected to continue. So let's stack the numbers. COMEX, 90.92, thin registered, huge recent deliveries, first notice day. Shanghai, 101.48, double-digit premium, confirmed physical tightness. That is not a healthy, integrated global market. That is one system, Western paper, trying to hold a lid on price, while another, Eastern physical, simply pays more because it needs the metal. When silver tests $92 tonight, a breakout on COMEX is just COMEX being dragged a little closer to what Shanghai is already saying the metal is worth. It's a sign that the paper ceiling is losing control to the physical floor. Segment 5, why tonight's close matters more than the intraday spike. Intraday spikes mean nothing if they get sold back under the wall before the close. What matters tonight is where silver finishes. Scenario 1. Silver pokes above $92 intraday but closes back under. Shorts get a swing failure to work with. They can say, see, every break above here gets rejected. March starts with a psychological win for the short side, even if the underlying stress hasn't disappeared. Scenario 2. Silver breaks above $92 and closes above that level. The wall is no longer just resistance. It's now broken structure. Anyone who shorted into that level during the last halt, or who averaged into shorts in the high 80s, low 90s, is now underwater. Longs who stood for delivery see confirmation. Price is rising even as they lock in the right to take metal. Why this close matters? It happens with 52.63 Oz already claimed for March and 86.13 Oz registered. It happens with 74.38 millimAs already delivered in 2 months, nearly a full registered stack drained. It happens while Shanghai is already trading over $100. In that context, a daily close above $92 on first notice day is not just a bullish candle. It's a vote of no confidence in the idea that COMEX can easily manage this delivery cycle. Segment 6, the delivery squeeze math of $92 breaks. Let's run a simple stress scenario. We know, registered 86.35 O's. March standing 52.63 Oz. Jan-Feb delivered 74.38 Oz. If silver closes above $92 tonight and momentum attracts more longs, some shorts who were counting on rolling out of March may now think twice. Rolling at higher prices is more painful. Some longs who were on the fence about delivery may now decide to stand because the trend and fundamentals are aligned. The 52.63 Mons Oz standing is the starting number. It can rise as first notice day passes and more notices are filed. If March delivery demand creeps up towards, say, 60-70 Oz and registered stays in the mid-80s, you're suddenly in a world where more than 70-80% of registered is being called on in a single delivery period. COMEX can try to coax more metal into registered from eligible, but that depends on owners' willingness to convert. Failing that, the only tools left are higher prices, incentives, or cash settlements. A breakout above $92 tonight increases the odds that longs press their advantage instead of quietly rolling over. Segment 7, the macro wind. COMEX tightness and bullish forecasts. Recent silver outlooks are not neutral on this. A Metal.com XIG forecast notes. A 31% drop in COMEX inventories is fueling concern over a growing physical supply crunch. Registered silver stocks below 90 mmol Oz are explicitly called out as a risk factor. Analysts now see COMEX tightness as a key pillar for a bullish silver outlook rather than just noise. Seeking Alpha's late February COMEX piece adds, concerns about a potential March 2026 COMEX silver delivery failure are rising, driven by high demand and low registered stocks. The massive delivery volumes in January and February are described as unsustainable if the trend continues. FX Leaders frames it like this. Silver rockets past $90 as COMEX delivery panic and 189% gains ignite safe haven demand. This is the backdrop behind your $92 wall. It is not just a random pump. It is the logical consequence of a system that used COMEX as a silver ATM all winter. now has to deliver again in March and is watching the price creep back toward the level where the last slam started. Segment 8, Gold, Risk Sentiment, and Why Silver is Outperforming. Check the broader tape. Money Control's live coverage. COMEX Gold has crossed $5,200 in this latest run, with silver up about 2.2% today. Gold is behaving like a classic safe haven. ETF flows are increasing. Central banks, including India's, are buying. World Gold Council's David Tate notes that ETF flows are expected to keep driving global gold demand. Silver's role, it rides both the gold monetary trade and the industrial story. In risk-off modes, gold leads. In acceleration phases, silver often outperforms. The fact that silver is pushing toward $92 while gold is already at record or near record levels is exactly the setup you expect when the monetary bid is strong, the industrial and structural deficits are intact, and the derivative structure, COMEX, is showing strain. Segment 9. What changes for March if $92 breaks? Let's summarize exactly what changes for March if silver closes above $90 tonight. Technical regime shift. The market moves from rejected at 92 to accepted above 92. Shorts lose their clean recent sell zone. Price action signals that the last slam was not enough to cap the move. Delivery psychology longs who stood for 52.63 mere Oz of delivery feel vindicated. More longs may file notices, pushing that number higher. Shorts face a choice: deliver, negotiate, or scramble for metal in a rising market. Volatility expectations. Coverage ratios already point to thin backing. A breakout at the start of the delivery cycle raises the probability of mid-month volatility spikes as more metal leaves registered. Narrative shift headlines turn from silver slammed to silver breaks key resistance into tight COMEX delivery. That narrative is fuel for both retail and institutional flows. Paper versus physical gap. A move above $92 brings COMEX closer to Shanghai's 101.48, narrowing but not erasing the gap. It underlines that the true reference point is moving and that Western pricing is being pulled up by Eastern reality. If silver fails at $92 again, shorts get to say nothing changed. If it breaks and holds, the March delivery cycle becomes a live stress test, not just a calendar event. Segment 10, How to use this information tonight. This is not a call to FOMO into a trade 5 minutes before the close. This is a map. Tonight, if you're watching the tape, watch where silver trades relative to $92 into the New York close. Watch for strong intraday break through 92 with volume, or quick rejection and close back in the high 80s. At the same time, keep an eye on any fresh COMEX warehouse updates for registered changes. Look for follow-up on how many March contracts actually stand after first notice day. Does 52.63 net Oz stay flat, rise, or get mysteriously managed? Big picture. You now know that $92 is not just a random price. You know COMEX has about 86 Met Oz registered, and 74 Met Oz moved out in the last 60 days. You know 52.63 Met Oz is already claimed for March. You know Shanghai is at 101.48 with a 13% physical premium. Tonight's candle sits on top of all of that. Use this information with logic. Size your positions so you can survive both outcomes. Think in terms of structure, not just one day's emotion. And remember, the wall at $92 is a line drawn on a screen. The real story is in the vaults and in the physical bids that don't care about your chart.